Opendoor recently traded around $4.45, an impressive surge from its 52-week low of half a dollar, yet a pullback from its recent high of $5.87. This is a stock that has become a lightning rod for conflicting narratives. The mainstream view, often echoed by traditional analysts, is that Opendoor is a capital-intensive iBuying business that is simply a bet on the housing market. They look at the recent second quarter 2025 earnings report, which showed a substantial sequential revenue decline and a return to adjusted EBITDA losses for the upcoming third quarter, and see a company on a path to another cyclical downturn. This is the expectation, but the reality is far more nuanced, and it's a story of a fundamental under-the-radar pivot. The true, compelling story of Opendoor today is not about a return to the failed iBuying model. It's about a quiet strategic transformation into a capital-light, agent-empowering technology platform. This is the insight that is driving the quiet confidence of its most ardent supporters, and it's a reimagining of the company's core business model that changes its entire risk-reward profile, a development that is far more significant than the meme stock volatility that often dominates the headlines. The deeper analysis begins with a dissection of the company's recent financial performance. On the surface, the second quarter of 2025 looked like a mixed bag. The company announced revenue of $1.6 billion, beating analyst estimates and achieving its first quarter of positive adjusted EBITDA since 2022. This was a major milestone that seemed to signal a turnaround. However, the subsequent guidance for the third quarter of 2025 was grim, with a forecast of revenue in the range of $800 million to $875 million, nearly a 50% sequential decline, and a return to adjusted EBITDA losses. The prevailing reaction was to focus on this negative guidance, concluding that the Q2 profitability was a one-off event. But this is where the surface narrative falls short. The company's management explicitly stated that this projected decline is not just a function of a deteriorating housing market, but a deliberate and strategic decision to dramatically reduce its high-risk home buying activities. This is the application of its new model in real time. Opendoor is willingly sacrificing top-line volume in order to shed its old capital-heavy business and pivot toward a more sustainable and less risky model. They are reducing the number of homes they purchase, as evidenced by the 63% year-over-year drop in acquisitions in Q2, even as they continued to sell through their existing inventory. This intentional contraction, while painful in the near term, is a necessary step to align the company's business model with its long-term vision of becoming an asset-light real estate technology platform. The core of this strategic shift lies in Opendoor's new agent-led platform and its Cash Plus product. The old model was simple. Opendoor buys your home for cash, and you avoid the hassle of showings and market uncertainty. The problem, as we saw in 2022 and 2023, is that this model exposes the company to massive inventory risk and requires billions in debt to scale. The new approach is a masterstroke of business model innovation. Instead of competing with real estate agents, Opendoor is now empowering them. The company offers a Cash Plus option where a seller receives a competitive cash offer from Opendoor, which then becomes a guaranteed, no-hassle backup. The seller can then work with their agent to list the home on the open market, seeking a potentially higher price. If the home sells to a third party, the agent gets their commission, and Opendoor earns a referral fee. If the open market sale falls through, the seller can still fall back on Opendoor's original cash offer. This is a brilliant framing of the problem. Opendoor is no longer just a buyer, but a provider of liquidity and certainty to the entire real estate ecosystem. This model is capital light, it aligns Opendoor's interests with those of real estate agents, and it leverages the company's core technological and data assets without the attendant balance sheet risk. The company has already reported significant early proof points, including listing conversion rates that are 5 times higher than their traditional channel. Let's now turn to the critical role of technology and data, which is the most powerful and underestimated asset Opendoor possesses. While most see a company that buys and sells homes, the true long-term value is in the proprietary data set it has amassed over its existence. Every home assessment, every cash offer, every customer interaction, and every market trend has been meticulously recorded. This data allows Opendoor to create a dynamic pricing algorithm that is arguably the most sophisticated in the industry. It can predict home values with a level of accuracy that is difficult for a human agent or a traditional brokerage to replicate. This is a formidable technological moat that allows Opendoor to offer a product that is uniquely valuable. Furthermore, this data is the foundation for a suite of future products and services that extend far beyond simply buying homes. Imagine an AI-powered tool for agents that provides them with real-time, data-driven insights on pricing and market trends, or a mortgage service that uses Opendoor's data to offer instant pre-approvals. The company's recent strategic moves, including the search for a new CEO and the ongoing refinement of its tech stack, are all signals that it is preparing to fully monetize this technological advantage. The stock is not just a bet on the housing market, it is a long-term bet on the digitalization of real estate and the power of a proprietary data set to disrupt a multi-trillion-dollar industry. The recent volatility has been fueled by a high-profile hedge fund manager championing this long-term vision, recognizing that the company's stock, while risky, represents an asymmetric opportunity rooted in this technological transformation. The macroeconomic environment, while a clear headwind, is paradoxically a catalyst for this transformation. High mortgage rates have created a lock-in effect, severely restricting transaction volume in the traditional market. This environment is precisely what makes Opendoor's new Cash Plus model so valuable. In a slow, unpredictable market, the ability to secure a guaranteed cash offer provides a level of certainty that is invaluable to a seller. It's a risk mitigation tool that allows them to list their home on the open market without the fear of the deal falling through, as they have a guaranteed backup. This is a powerful selling proposition that becomes even more compelling in a challenging market. This challenges the conventional wisdom that Opendoor only does well in a hot housing market. In fact, its new business model is designed to thrive in a market of constrained inventory and high transaction uncertainty. It's a contrarian bet on a slow market, and it represents a massive opportunity if Opendoor can successfully scale this model. This also addresses the company's ongoing liquidity concerns. The old model required billions in capital to buy homes. The new model, by contrast, is far more capital efficient. This reduces Opendoor's reliance on debt markets and strengthens its balance sheet, making it more resilient to fluctuations in interest rates and credit markets. In summary, the popular narrative of Opendoor as a failed iBuyer facing another cyclical downturn is a simplistic and incomplete picture. While the grim third-quarter guidance and the challenging macroeconomic environment are undeniable realities, they are being misframed. The deeper reality is that this is a company in the midst of a radical and deliberate transformation. It is shedding its capital-intensive, high-risk home flipping model and repositioning itself as an asset-light, agent-empowering real estate technology platform. This tension between the old failed expectations and the new promising reality is what makes Opendoor's story so compelling and its stock so volatile. The company's financial performance should no longer be judged by the volume of homes it buys, but by its ability to scale its new capital-light initiatives and monetize its powerful data set. This strategic pivot, more than any market trend or meme stock frenzy, is the central engine of Opendoor's future, and it is a powerful argument that the company's long-term potential is being vastly underestimated by a market